actual playoff tickets if the Jags make the playoffs. So why would we do that? Well, you can imagine a scenario that if they make the playoffs, the tickets are going to be worth more than $50. So in that case, it makes sense potentially for an avid fan like myself. You pay $50 in the hopes that the Jags make the playoffs, and if they do, with like they did this last season, well, now I have the right to buy tickets to this playoff game for $50, and they're probably going for $300-400. That's useful for me. That was a profitable venture for me in this case. What is the purpose of that? Well, now I can either go to the game and only pay $50, or I could buy the tickets and sell them to the highest bidder currently out there in the ticket marketplace of sorts. So that was helpful for me. What was the issue? Well, the Jags had to make the playoffs. Had they not made the playoffs, I would have just been out $50. That's the issue that we run into, is that it needs to have something happen in that case. So the person who sold the calls, the Jags in this case, they came up with what they thought was this brilliant idea. We'll sell all of these eventual IOU tickets of sorts, and if the Jags don't make the playoffs, they get to pocket all of that money. But what's the issue that if they do make the playoffs? Well, now they have to sell all of these tickets for a steep discount, or have they already sold them at a steep discount when they could have not done that and simply just sold tickets for the prevailing price of a playoff venture? That's the trade off to be found. We're trying to have an advantageous move to the upside. Now, what about on the long put side of the equation? If long calls give us the right to buy 100 shares of the underlying, what does a long put allow us to do? A long put entitles the buyer the right to sell 100 shares of the underlying at that strike price up to that defined expiration date. Said to be long the put, but you'll notice being long here is bearish. Why? Well, effectively, we are speculating on downside. We are speculating that the underlying going down would benefit us. And the person selling that, again, if I'm buying the long put, Albert's selling that to me, he is taking on the obligation to have to buy those 100 shares if assigned at that strike price up to that expiration date, short the put, paid a premium for being short that put, but in essence is bullish. Why? Because he wants the underlying to go up, because that's what is advantageous to him as the put seller. What is this analogous of? To me, not to make things too Florida oriented, but I tend to think of insurance in this case, homeowners insurance, car insurance. I'm no stranger to the world of hurricanes down here in Florida. If you are an insurance company, what are you generally doing? Well, you are selling someone the hopefully cost of a rainy day perspective of taking on risk. When you're buying insurance, what are you ultimately doing? Where you are buying something that if something bad happens to your home, to your car, to your cell phone, whatever you're insuring, well, you're hopefully getting paid out for that. That's what a long put is, similar to if we are combining it with, say, a long share position. Now, can you just simply buy a long put to try to speculate on downside price action? Absolutely. That's the function of it. So when you're selling someone that put, if someone out there is selling that put, that's the function that we have to remember. We are then taking on that obligation, that risk of downside price action. So in that case, we have to think about it through that lens. Now, the issue across the board is always going to be that in reality, the pricing of options becomes a more complex nature. It's so simple to think that, hey, I'm buying this call option, and say it's a call option to buy the underlying for $100, and I'm paying $1 for that. What actually determines why that option is worth $1? Why is it ultimately worth $1? It is some sort of combination of these two things here: intrinsic value and extrinsic value. Intrinsic is very easy to understand. If I have the right to buy the shares at $100, so I have a call option I bought, and I have the right to buy the shares at $100, and the underlying is currently going in the open market for $110, intrinsically, I know I have a $10 value option because I have the right to buy the shares at 100. I can immediately sell them at 110. So that option is intrinsically worth $10. What if the option, though, is worth $12 in the open market? Why is it worth $12? Anything that is not the intrinsic value simply gets called the extrinsic value. What ultimately determines it, where does it derive from, is a function of, I mean, as Albert mentioned, something that we could spend hours discussing along the way, thinking about it through the lens of what all determines different perspectives of extrinsic value. But ultimately, it's the market's determining function of what the remaining amount of time that is left on this options contract is worth to the marketplace. If I have this option I bought and it's $10 intrinsically valued, but it's got a year's worth of life remaining, well, the market knows that that time that it has remaining is worth something. What it's worth is going to be determined by the marketplace, but it's worth inherently something to have that much time that remains on the market. So, nonetheless, let's look an actual options chain. Because when we think about the world of options, it's so easy to think about these scholastic perspectives that we discuss, long calls, long puts, things like that. But it's important to dive right into an actual option chain, see what some things look like. So let's use SPY as a proxy for this currently this period of time. There's going to be a lot of different dates and strikes and everything for SPY. It's the most highly traded option chain, generally speaking, across the board. But let's go out to, let's say, the April expiration for this. Right this moment, SPY is going for 686 or so. I have a few different options, no pun intended, out here in front of me. I could buy the call if I think the underlying is going to go up. I could buy the put if I think the underlying is going to go down. I could sell, I could buy anything that we've combined here. But what ultimately needs to have happen? Well, you'll notice that 686 and 50 cents, there's not a whole lot of actual intrinsic value at this moment in time. In fact, let's add that column to the mix, intrinsic and time value, aka extrinsic value. This call contract's only worth 40, 50 cents intrinsically, because if I have the right to buy the shares at 686 and they're worth 686.34, 34 cents of value inherently, intrinsically. But it's going for 17 bucks. Why? Where does that 17 bucks come from? $17 effectively is the pricing of what 1 month or 46 days actually is worth of time of movement in the underlying is worth to the open market at this period of time. The open market gets to decide these. This is a simple market dynamic, market mechanisms, buyers and sellers interacting that create these prices along the way. Now, something that we've mentioned and should always be reiterated, when you see these prices, they are quoted on a per share basis. And what does each underlying options contract entail? 100 shares. So when we say 17 bucks, in this case, it is $17 per share times 100 shares, $1,700 of actual value out of our pocket. That's why this maximum loss is notated here. That's the worst case scenario. This option expires worthless. That's where the option seller benefits from. They get all of that premium that they took in from the buyer and pocket it because the option expired worthless. So there's a variety of different ways that we can take this, but ultimately every single type of options trade, no matter what you see, if you see what calls, puts, straddles, strangles, condors, butterflies, all of those different things, they are some combination of that chart that we looked at earlier. It is some combination of those four strategies that we discussed. Long call giving us the right to buy the shares, short call obligation to have to sell the shares, long put right to sell the shares, short put obligation to buy the shares. Everything boils down to these four strategies and what side of the strategy we ultimately find ourselves on. No, I've been going for a handful of minutes though as well. Anything that you wanted to dive into next, Albert, and take a look at our questions that came in?
Yeah, one great question that was asked. I think that would be a good idea just to address it because I think everybody will benefit from it. And that is, the question was from Eric: does an option seller need to own the underlying shares? And the answer is yes and no, depending on the situation. But let's think about, for example, a short call because I think this is probably the best way to illustrate this. If we think about a short call, how many people are familiar with the concept, or at least have heard the term covered calls? Yeah, that's great. And that's usually one of the first things that people look at when they start to trade options. And what a covered call means is that you own the underlying stock. You own 100 shares of whatever, Apple, for example, and you decide to sell a call against it. Remember, what does the selling of the call give you? It gives you the obligation to deliver shares at some point. So by selling a covered call, you're saying that I've got the shares, and if at some point in the future it gets to the strike price, I'll sell them to you at that strike price. And for doing that, you receive a premium. So that is the covered call. The other side of the short call is if you don't have the stock, and that would be called a naked short call. Remember early on, I asked you about how many people have heard that options are risky and inherently risky and stay away. The naked short call is about as risky as you can possibly get. That is an absolute advanced or professional type of position because what, again, does that mean for us? Well, remember what I said before is you have an obligation to deliver stock at some point. If you don't own it, what does that mean you have to do? Let's think about a very basic scenario where you sell a 100 call and you don't own the stock. That means that if by expiration time the stock goes to 200, you have to go out and purchase the stock in the market at $200 and then immediately turn around and deliver it at the strike price, $100. That's not a great position to be in. That's not something you could, leverage up and do bigger size in. That's a terrible trade for anybody. And remember, stocks can go as high as they want to. It could go to 300, 400, 500. It doesn't really matter, right? I mean, it could go as high as it wants to. A very risky position would be to be short a naked call. So, again, the answer is you don't have to be, but if you're not, that's a very advanced type of position. And make sure you understand it. Make sure you, of course, the nice thing about having tiers of option approval is making sure that you have the ability to understand and support those types of trades. But for our purposes, especially in the beginner section, we're going to be thinking about a short call would be something that would be more like a covered call. A short put, on the other hand, also very risky. The only limitation here is it's limited by zero. And so when we talk about short puts, typically, at least on the beginner side, we're talking about cash secured puts. In other words, we have the money if we are called upon or have to meet that obligation of buying stock at some point in the future. So great question. Huge difference in those two trades. And we should always keep that in mind. We'll get more into that as we get into selling options in week 3, but something to keep in mind as well. All right. Real quickly, a couple of things. I'll just touch on this real fast, Andrew. I don't want to spend a lot of time, but as I said before, the anatomy of an option symbol, you typically don't have to know this in our system. A lot of times the system is actually set up in such a way that you don't have to know the information about the symbol itself, but we can always talk about it. Real simple. This is an option symbol, as you can see, for the SPY January 21st of 2022 call at the 208 strike price. So you can probably figure this out. The first three, of course, are the symbol itself. The next is the year. The next is the month. The next is the day of expiration. The next piece is C or P, call or put. And of course, finally, the strike price. So you can decipher any of these symbols if you need to. The one thing I'll point out here, and this is going to be public service announcement number 2. Remember what I talked about with those adjusted options? If you see a symbol of an option that it has the date part has 6 digits, right? Year, month, day. If you see one with 7 digits, so this might say SPY1 or SPY2 or SPY3, and then a date, 7 digits total, that's an adjusted option. That's another way you can spot adjusted options. Again, if you ever have an issue or want to understand about those, the OCC.com, THEOCC.com, they have all the information you need about adjusted options. All right. So, how are we feeling so far? Good? Are we getting a feel for this? Starting to understand some basics about the options themselves. I want to get to the next part. I know probably a lot of questions about this, the exercise and assignment. You know, I don't know the exact number, Andrew, but it's pretty big, right? The amount of option contracts that actually are closed out prior to expiration is somewhere in the vicinity of 85 to 95%. In other words, traders will buy an option and then close it out before expiration and not actually go through with the exercise. Nonetheless, we should always understand how these things are going to work, because if we were to hold on to an option and it is at least a penny in the money, it will be automatically exercised. Now, what is exercise? That is, exercising a call is when the option holder decides that they want to buy the underlying security at the strike price. The put is simply they decide they want to sell the underlying security at the strike price. Remember, if the option has intrinsic value of at least a penny at expiration, it will be automatically exercised. If an option has no intrinsic value at exercise, it will be expire worthless. This goes back to the slide that Andrew was showing us about the premium. Remember, if we talk about intrinsic and extrinsic value, the intrinsic value is simply a math equation. How much is it in the money? If we have a 100 call and the stock is trading at 105, well, we're $5 in the money. We have $5 of intrinsic value. The other part of that extrinsic value, that's what gets taken out by the time we get to expiration. In other words, at expiration, the option is going to either have some intrinsic value, $5, for example, or it's going to be worthless and go out worth nothing. So when we talk about the concept of exercise and assignment, if we have intrinsic value of at least a penny at expiration, it's going to be automatically exercised. If it has no intrinsic value at exercise, it'll expire worthless. Which brings me to public service announcement number 3. If you have a position in your account that has intrinsic value on the day of expiration, and you cannot support buying 100 shares, please be aware of that. Please communicate with our service team. Let them know what your intentions, because if you have an option that has value to it and is in the money, and you can't support that per exercise or buying 100 shares, Fidelity can and will sell that option out for you. So again, on the day of expiration, if you cannot support buying 100 shares in your account, please communicate with our service team. Let them know, especially if you want to have the say-so as to when you sell that option. That's very important to remember. Obviously, from a standpoint of exercise and assignment, long options are exercised. Short options are assigned. I can't tell you how many times on the service side I've taken a call, hey, I want to exercise my covered call. Doesn't work that way. You are short a call when you're a covered call. You don't get to exercise. You are assigned. You have the obligation. Long options have rights and therefore get to exercise. Short options or sellers take on obligations and are therefore assigned. So hopefully that makes sense. Keep that in mind. That is the main difference. All right. So what is assignment? What happens during that situation? Well, the assignment is, if you're a call, if you have the option writer or seller of calls, they have to fulfill their obligation to sell the shares at the strike price. Remember the covered call example. If we were to sell, a covered call and the stock's trading at 100, and next thing you know, we sold a 100 call, and by the time expiration is trading at 101, we have to sell the shares at that strike price, 100. Of course, don't forget, we also took in a premium to have that obligation. Assignment of a put is when you have to buy the shares at that strike price. So we sold a put, took on the obligation that at some point we may have to buy those shares at the strike price. The option seller, again, does not choose it from when the assignment will occur. The option buyer controls the action. Assignment occurs when they choose to exercise their option. The way assignment happens is a double blind assignment, essentially. The OCC blindly chooses a brokerage firm, and the brokerage firm blindly chooses an account. So when you get that call or that assignment, that means you have to deliver on that obligation. A short option can be assigned at any time, even if it has no intrinsic value. Now, we'll get into this more a bit later, but keep in mind that a situation with American style options for stocks or ETFs, it can happen at any particular point in time prior to expiration. What is one of the main scenarios where we might see an early assignment? Does anybody know the answer to that question? The main situation that we see a potential for an early assignment is if we have a position with a covered call. So in other words, we own stock and we sold a call against it is if the expiration happens to encompass a dividend payment. So think about what that means. If you have stock, you're entitled to dividends. If you own a call, you are not entitled to dividends. If we were in a situation where the stock was close to the strike price, in other words, the dividend was worth more than the difference between where it was currently trading, a lot what you might see is that people will early exercise those calls to get the stock and receive the dividend. So if you're a covered call seller, be aware of dividends around the time of your expiration. That could factor in. Not always, but absolutely there are scenarios when that will factor in. I've absolutely seen it. Be aware of it. I guess that's public service announcement number 4. Be aware of dividends if you are a covered call seller. All right, moving on. Let's take a look at an example here of a long call, an American style. An option holder who exercised a long XYZ call at 146 would purchase 100 shares of XYZ at 146 per share or $14,600. If they did 10 of those, it'd be $146,000. Remember, if it has intrinsic value, it will be automatically exercised. So this is what I was talking about. If you were the person that held this call and the stock was trading higher and you held it to expiration, if you didn't have the ability to pay $14,600 or $146,000, that's something to be aware of and make arrangements to take care of that situation if you don't want it to be automatically taken care of for you. Remember, American style can be exercised at any time. Now, of course, there are reasons why we wouldn't necessarily early exercise. There's value to those particular calls, but it can be done at any particular time. Let's actually take a quick look at something because we can see an example of what this might look like on an option chain. So let me pull up my Fidelity Trader Plus. And let me pull up an option chain. And let's take a look at something because I think this is going to be an important example of what do we mean by time value. And I'll change this to SPY. It looks like it might be paused here, Andrew. I might have to call you in as a backup here.
Yeah,
Oh, there
no
we go.
problem. There we
We're
go.
good. All right, so let's take a look at SPY because this is always a good example of SPY. Let's take a look at something, we can even look at today or we'll look at tomorrow and maybe the end of the week. So we're trading currently at 686.83. Well, this is one day, right? This is tomorrow's expiration. 686 call, which at this point would be what? 83 cents of the money, 84 cents of the money. Well, guess what? It's actually trading for $3.10. So the question becomes, why would you want to early exercise this call? If you own this call, let's just say you paid $2 for it at some point in the past. That means that if you wanted to exercise it, you could exercise it right now and buy the stock at 686. But don't forget, what's your break even on this? Your break even is 686 plus $2, 688. So if you were to exercise at 686 and just buy it right here, you're actually going to be losing $2 because you paid for that option. However, what you could do is say, look, I'm going to sell my option out at $3 and then just go into the market and buy it at 689.89. What is that? What just happened? Well, you paid 89 cents more for the option, but you actually made $1. In fact, you're selling it for $3 instead of exercising it. So there's time value in these options. Same thing with this one, going out to next week. This is, or excuse me, end of week, 4 days. It's over $6 for that particular option. Why? There's no reason to go and exercise this and buy the stock at 686 when you can sell the contract out at $6 and still buy it at 686.85. Hopefully that makes sense. That's usually one of the main questions we get about early exercise. Why would you do that? Oftentimes, it's not really something you would do when you're near the money or in those situations. It changes when we have something that's way far out of the money because when we're way out of the money, it doesn't necessarily have a lot of time value. But that is a quick look at early exercise and why oftentimes it doesn't make a lot of sense. This is kind of a complex one, Andrew. Anything you want to add here before we move on?
Yeah, I think when people first learn about options, it's important to learn it from the lens of what happens at expiration. But like you mentioned, the thing to always remember is that these are dynamically traded prices, dynamically traded products. So at any moment in time, you can close your position. Assuming that there's a counterparty out there, assuming that there's value to the option, you can always close it. Imagine if you had been someone who bought the call contracts that you see at the upper end of this yesterday. You can see that, or I guess Friday, you could see that they are down and you could just simply close the position. There's nothing stopping you from ever closing a position as long as there is some sort of party out there that wants to buy that from you. So always keep that in mind. And to keep in mind too, something that you mentioned, Albert, is that a lot of the times people think that just because something goes in the money, it gets assigned or it gets exercised. And it's ultimately up to the person who has that contract that they've bought. So, right this moment, just to reiterate the point that Albert was making, let's imagine if we have been just very correct on the movement of SPY, and now we have a contract. Let's even go deeper in the money. Let's go a handful of strikes out. Let's just say we bought the 675s. Right this moment, the 675s, they are intrinsically worth $12. You have the right to buy the contracts or buy the shares at 675 and they're worth 686. So we know that they're worth nearly $12 intrinsically. Does that mean that you should exercise them? No. And I saw that question that came in. Mark asked, what's the virtue of exercising a long option before the date? Almost there isn't any. No, more often than not, it does not make sense to exercise an option seemingly much before expiration. What really determines it? How much time value does it have? If there's any amount of time value, more likely than not, it makes more sense to just close the position and reorient if you want the shares. What do I mean by that? Let's say that you called into Fidelity and you wanted to exercise this because you want 100 shares. You want 100 shares of SPY. You don't care that your call contract has whatever the person's telling you, it has time value, and you don't care. You just want the 100 shares. Well, what could you do to get that 100 shares? Rather than exercising these contracts to buy the shares at 675, you could just go buy 100 shares at 687. Just go buy 100 shares and then sell to close this contract for $25. What have you ultimately effectively done now? You've basically bought the shares at 662, all things considered. That's why it does not make sense to just give up that time value. And that's why you don't generally see people exercising until things get closer to expiration or very in the money. Let me see if I can find an example. If we go very, very down the line here, you'll notice that a 300 strike. So, I mean, as in the money as it can get on the chain, it's got 50 cents of time value, basically. And you'll notice that there's a 30-cent difference in the bid and the ask. So, right this moment, you might have a difficult time getting your real intrinsic value out of it without exercising. That's when people start to explore the actual exercise. Or maybe if you'll notice this is on the April expiration, let's go to today's expiration or tomorrow. Let's still keep it at today because these have daily expirations. These don't even have like a penny of time value the further you go down the chain. And they've got a wide spread. So you'll notice then it's difficult to actually get the value you deserve out of some of these contracts because they're so in the money and they're so liquid that at that point, exercise might be the only way to actually capture that value. But that's why it is contextual. Each individual situation is different. And ultimately, in the end of the day, you have the right to exercise it. That's the right that you bought. So you have the right to exercise something, whether or not it makes sense for you to exercise it. And that's the thing that you have to keep in mind if you have sold that option. Imagine right this moment, let's go back to the April expiration. Imagine you had sold, let's go to a more close in one here. Imagine you had sold this 680 and it's worth $7 intrinsically. And then all of a sudden you sell your shares at 680. You just got to keep some of that time value that was in that position. It didn't make sense for that person to exercise it, but they did it anyway. It's their right. At the end of the day, they get to decide when to buy or when to exercise or when to do anything like this. So it's always important to think about this. I saw Mark also asking, what is the significance of strike price just to separate in and out of the money? It's just all of these different contracts exist for those different reasons. Generally speaking, very, very liquid option chains will have more strikes because there's more players wanting to interact with this underlying. Imagine though, you look at, say, a different one. I always use this one because it's a very high priced underlying relative to its volume. And you'll notice that now rather than a strike at every dollar, we've got one every $50 because there's just less demand for that many strikes. Or if you go to something like Ford, a lower dollar per share price, we have one here, but it does not go very far because they just don't exist nearly as much. So every single underlying option chain is going to be slightly different because they have different profiles of who's interacting with them. The more and more people that are interacting with the underlying, the more that's going to make a difference. I think let's try Intel for sake of a comparison here. I know this one's, of course, a name that most people tend to recognize, but I guess this one does have still a handful of different option chains accordingly. So plenty of things that we can find. So, but every single one is different. And you'll notice that we were just looking at SPY has thousands of contracts trading. Now we're looking at a couple hundred on a handful of them because there's just less people interacting with this. I saw Mark asking, is the aim to get the premium multiplied by 100 if the time ends in the money? Every single option strategy is going to have a different outcome that you're most wanting. And that's the fun thing about option strategies. It allows you to be very specific in what you are trading. Because one thing that you'll remember on some of these other names is that if we think about the perspective of long or short options, calls or puts, you potentially have the benefit to benefit from time decay, from neutrality in the marketplace. That is one defining difference maker between options and underlying share trading. If you believed, let's just say for SPY here in the last year or so, imagine if you remember, let's see if it'll load for me. I noticed we had a little bit of some glitches today. So if you'll notice on these in particular, let me switch over to my Active Trader Pro and do that instead, that in the last 6 months, basically, had you been someone that said, hey, I think the S&P 500 is not going to do hardly anything for the next 6 months. If you notice that the high price at the end of October, 68.90, where are we right now on the S&P? 68.85. 5 points of movement between October 29th and now. Now we've had some range up and down, but we've effectively done a whole lot of nothing in the last few months in the S&P. If you had that outlook, if you somehow had a crystal ball back in October that said, hey, on March 2nd, we're going to be basically the same price, what would you do? If you traded shares, well, hey, there's not a whole lot of anything to be made by nothing happening. That's the issue from time to time is that when you're a share trader, you have to go look for those opportunities that are out there because movement is a necessity. The fun thing about options, it's not inherently for short options. If you are a seller of options, you can benefit from neutrality. You can benefit from time decay, from volatility decay. We will dive deeper into that during the week in that case. But that being said, I do want to circle us back to a few things on the website in that case. A few people asking if there is a recording of today's event. Although these individual sessions are recorded for compliance purposes, they are not recorded for distribution purposes. However, on Fidelity.com, if you search for options trading at Fidelity, I'll go back to the search results. You just have to look for the one that says video when you do that, options trading at Fidelity, and then you'll scroll down to the one that says video here. When you click on that, it is a combination of pre-recorded events from this options classroom as well as the options intermediate classroom. So you'll notice session one, introduction to options at Fidelity. It is more or less a recording of what content Albert and I went over here today. Now, I do think it is a couple of individuals, still one that is still on our team, or both of them still on our team, Nicholas DeLis and James Savage, luckily. So some familiar faces if you're familiar with our team, but these are slides and are pre-recorded events that you can find on the website. And on that page too, keep in mind, a couple of things that you can always access for the options trading classroom. One, you can access the slide deck that we've been using at this page in particular, as well as the first thing we'll do next week when we open up the classroom is go over this week's homework. That being said, we are right at time, give or take. Want to give you a moment before we wrap up for today here, Albert.
Yeah, again, this is a complex topic, right? And there's absolutely a lot of things to understand and learn about with these particular contracts. And the goal today was not to have you be proficient in it. The goal is to at least give you a basis for understanding what this is all about and how maybe we can start to think about these things. And again, if you have the ability, there's an opportunity here coming up tomorrow to do some reinforcement and follow up what we did today. that option pricing 101. It's going to be a lot of the same material. We'll dive right back into it and go over it one more time. It's a great way to reinforce everything that we talked about today. And also, there's that homework as well that Andrew showed us. Do that. We'll cover it next week before we even start getting into the new material. It's really a situation of just repetition. It's like you get all these terms, and it's like the proverbial drinking from a fire hose, right? It's just too much coming at you at once. Take the opportunity to go back through that on-demand stuff. Take the opportunity to attend some additional sessions about options, and we will absolutely go over that homework next week before we start things off. So until next time, hope everyone has a great rest of their day, great rest of their week. Appreciate you being here, Andrew. Always a pleasure, and we'll see you next time. Take care, everybody.
Likewise, take care, everyone.